Hello, welcome everyone. Today we're going to talk about Chapter 4, Completion of Accounting Cycle, Using Accounting Principle, an edition from the Wiley Plus book. Excuse me. This book is I have an author Reagan, Kiesel, Kimmel, Terholm, Warren, and Novak. Okay. We're going to start with Chapter 4 learning objective, which is to prepare closing entry and post-closing trial balance, explain the step in accounting cycle, including optional step, prepare our classified balance sheet, and 4, illustrate the use evaluate liquidity. Number 5, prepare worksheet, and number 6, prepare the reversing entry. In the completion of accounting cycle, there's a number of closing book that we have to do. Number 1, we have to prepare and post closing entry, and preparing the post closing trial balance. In the summary of the accounting cycle, we need to have to do worksheet, reversing, as well as doing correcting entries. There are a number of classified balance sheet as well, and using information in the financial statement such as working capital and current asset, and do an asset test ratio. What is the learning objective number 1, which is prepare closing entry and post closing trial balance. Closing books done at the end of the accounting period. After the adjusting of entries posted, financial statement are prepared. Accounts are made ready for the next periods. What are the temporary accounts? They are only collected data for a single period, closed at the end of the period. Example is revenue, expense, and owner drawing. So it is based on the closing temporary account. Why? It's because the reporting based on the fiscal year. Let's say January to December. That is called temporary account. Permanent account, it's not closed, but balance are carried forward into next period. This is mostly our balance sheet accounts. Okay. Now, closing entries. A transfer temporary account balance to the owner's capital account and update the owner's capital account balance. We just balance it in all temporary accounts to 0 so that they are ready for the next period. And then journalizing and posting closing entry are a required step in the accounting cycle. Revenue and expense accounts are closed to income summary, which is the temporary account. And then closing entry, what are they? They are revenue accounts. Go to income summary. Expense accounts, go to income summary. So income summary, go to the owner's capital. While owner's drawing, go into the owner's capital. The key is here at the bottom. Close the revenue to income summary. 2, close the expense to income summary. Number 3, close income summary to owner's capital. Number 4, close owner's drawing to owner's capital. And then, number 1, close revenue. What we're going to have to do? Debit each individual revenue, account for its balances. Credit the income summary for total revenues. And number 2, close expense account. We have to debit income summary for total expense and credit in each individual expense account for its balance. And then close income summary. Number 3, debit income summary to for balance, which is credit if loss, or credit owner's capital account if debit if loss. And then in terms of close drawing, debit owner's capital account, credit owner's drawing account to the balance. In post-closing trial balance, we must prepare all the closing entry that have been journalized and posted, provide the list of all permanent accounts and their balances. These balances are carried forward into the next period. Since all temporary accounts have 0 balance, only permanent balance account remains. Okay. On the post-trial balance, this is an example of post-closing trial balance. Remember, left and right has to be the same. Debit and credit has to be the same amount. Okay. This is example of the post-closing trial balance. This goes to capital here, 1272. Okay. Example provided. Learning objective number 2. Explain the step in the accounting cycle, including optional step and preparation of correcting entries. Accounting cycle summary. This goes to all 9 steps. Number 1, what are they? Analyze the business transactions. Okay, for example, selling samosa $1,000 to Bank of Montreal and receive the payment cash. So you need to do, number 2, journalize all the transactions and then post to the ledger entries for prepare the trial balance here, journalize and posting adjusting entries, prepare and adjust the trial balance, prepare all the financial statement, and journalize and post the closing entries, and then prepare the post-closing trial balance. We're gonna do it step by step in the next slide, okay? Worksheet on optional step. Multiple column form to help prepare adjusting entries and financial statement. A working tool is not permanent on the accounting record, useful for the preparation of internal financial information or for internal use. Reversing entries. Reverse certain adjusting entries made in the previous period. For example, if you make a mistake, then you can reverse it. Made at the beginning of the next accounting period to simplify recording of the transaction in the future of accounting period. It's correct error that have occurred in the recording process. Excuse me. Unnecessary if the records are free of errors can be journalized and posted wherever the error is discovered. Must be done before the closing entry are prepared and posted. Now, in the learning objective number 3 is to prepare a classified balance sheet. What are they? Financial statements are more useful when similar assets and liabilities are grouped together. Classified balance sheet generally has the following standard classification. This is an example of asset, current asset, non-current assets such as long-term investment, property, plant and equipment, intangible asset, and goodwill. That is the asset. Liability is an owner's equity, recurrent liability, non-current liabilities, owner's shareholders' equity. Current asset, what are they? Cash and other resources that will be converted to cash and sold or used up in 1 year from the balance sheet date. Can be longer period if operating cycle is greater than 1 year. It is listed in order of liquidity. Example, cash, short-term investment, receivable, inventory, supplies, and prepaid expenses. What is the operating cycle? It is the length what it takes that starting with cash to ending the cash within producing revenues. Usually less than a year, but some business it may be longer than a year. Example here in the cycle, cash is used to purchase inventory and pay for employees. Okay, and then service provided or inventory is sold, and then cash collected from customer go back again here. So this is the cycle, the 3 cycle here. The long-term investment is non-current asset. Investment in debt equity are expected to be held for many years. It is not ready, marketable, or expected to be converted into cash within a year. Example of this: investment in shares, bonds, long-term note receivable, as well as investment in land or resale. PPE, called property, plant, and equipment. It is non-current asset. It is long-lived. It's tangible asset that are used for business and not intended for sale. Example of this will be land, building, equipment, vehicle, and furnitures. Okay. Example of intangible asset and goodwill. It is non-current asset. Long-lived assets that do not have physical substances. Example, give a company rights and privileges. Example of this will be patents, copyrights, trademarks, trade names, and license. Example, the logo or the patents of Google is owned by the Google. And then you have Toyota. You have the name of Toyota, such as Land Cruisers, Corolla, Civic. They are it's basically a trademark as well as patent that has its value. We will review later the value of this goodwill in example of the goodwill as well as intangible asset of different companies. Okay, goodwill is similar to intangible asset. It is a right when a company is acquired at a price greater than the fair market value of the net asset. Okay, for example, your asset 100 million and then sold for 400 million. There's a 300 million goodwill. Okay, that's one example. Okay, let's go back to the chapter, this chapter before, to make sure you are aware. Let's move on to the next slide. Current liability is the obligation expected to be settled within a year from the balance sheet date in the normal operating cycle. The typical of this example will be account payable, note payable, interest payable, sales payable, and then revenues, current maturity of a long-term debt. Okay. Non-current liability, obligation that are expected to be paid after 1 year or longer. The example will be long-term note payable, bond payable, mortgage payable, risk liability, and deferred income tax. Okay. Equity. What are the equity? It contains of the equity can vary in terms of organization structure. Either proprietorship, one capital account under the heading will be owner's equity. Partnership, the capital account for each partner under the heading partner equity. Corporation and shareholders consists of section of share capital and recurring earnings. So there's three examples here: propriety, partnership, and corporations. Okay. Next one, comparing IFRS and ASPE. Statement name, IFRS will be statement of financial position, ASPE will be called balance sheet. Both allow it the name. Both IFRS and ASPE require separate presentation of current asset, non-current asset, and then intangible asset, including intangible asset, goodwill, and long-term investment, specific accounts. Okay, but Canada is now moving to IFRS as standard. When I was with Travels Canada, with Intech, we are doing an IFRS 17. Same thing when I was with BMO, is moving to IFRS reporting system as well. So that is the gold standard now in terms of reporting that adopted in the worldwide. Only thing, the only country that do not adopt IFRS at the moment is United States, USA. Okay, as of 2024. Learning objective number 4 is illustrate, measure, evaluate the liquidity. What are they? Liquidity is the ability to pay obligation as they come due within the next year. The working capital means it is important to measure liquidity. What are they? Current asset minus current liability. For example, here given to you is called the working capital. Current asset minus current liability will be called working capital. Here an example here. Okay. Let's move on to the next slide. Current ratio is the measure of short-term debt to paying ability. Current asset divided by current liability. That's the structure of the equation. So CA divided by CL equal to current ratio. In this company is 1.5. Okay. Asset debt ratio measure the investment intermediate short-term liquidity, which is cash plus short-term investment plus receivable divided by current liability. These do not include inventories because some inventory is not liquid. Okay, not as easily as liquid as the rest. So it's going to divide always divide current liability. We call it asset test ratio. Basically, current asset minus inventory, they call it asset test ratio. Okay. Number 5, prepare a worksheet. When we're gonna prepare a worksheet, we're gonna multiply column. Step in the preparing worksheet. Number 1, you need to prepare a trial balance on the worksheet, and then number 2, enter adjustment and adjustment column. Number 3, adjust balance and adjust the trial balance column. Number 4, adjust the trial balance amount in the corresponding column. Number 5, total columns and calculate profits. That's the appendix worksheet. That's the step that you have to do. There's 5 steps. Remember, guys, there's 5 steps. Okay. Okay, number 6 is to prepare the reverse entry in appendix 4B. The entries that reverse the adjusting entries at the beginning of next period used to reverse accrued revenues and expenses and simplify the recurring future transaction relating in adjusting entry. So the transaction is recorded. There's no need to refer back to any adjustment in determining how much relate to the prior period. Again, we're gonna make sure this is a copyright. This presentation has a copyright by 2020, John Wiley and Sons Canada. So this basically concludes chapter 4. We're gonna discuss later on chapter 5. Okay. Thank you, everyone. So hopefully you enjoy and learn from this presentation.